recording today's video during the wildfires that are hitting LA particularly hard. It's with our hearts and minds go out to those people who are directly involved, to the first responders who are helping. It is obviously going to be a very large economic disaster. It's also going to take people's lives and change them forever. 5 years ago, my in-laws lost their home to fire, and it's something that's really tough to recover from. So our hearts and minds are with them. And we'll just move on now and get into today's Informed Investor Market Update. Joining me today, Adam Phillips, Managing Director of Investments with EP Wealth. I'm Rob Black. Little report card on year to date. The S&P Mid Cap 400 is down 0.7%. The Nasdaq's down 0.8%. The S&P 500 is down 0.9%. The Dow Jones Industrial Average down 1.4%, and the Russell 2000 is down 1.8%. It feels like there's a rotation happening because last year's big winners, the mega cap tech stocks, are underperforming, and there seems to be a rotation into other areas of the market. But I'm going to let Adam expand on what he's seeing in the market because he is the expert here for that. Adam?
Yeah, well, look, I think it's just interesting. It's early on,
Yeah.
right? But we're seeing a lot of red on the screen so far this year. We could talk about why that is, but even if we go back into 2024, we've now given up all the gains that we saw from that Trump bump, right? So in the days that followed the November election, and so the markets are definitely skittish here. And we're seeing it across the board. And even the Magnificent Seven, those that have really been leadership for the last couple of years, they are lagging as well. In fact, only one of the Magnificent Seven companies, Meta, formerly known as Facebook, is positive so far this year. And so it's been a pretty broad-based sell-off. We are seeing some leadership change here. Whether it can continue, I'd say, remains to be seen. We've seen some head fakes in the past, but we are seeing a couple bright spots here in the market. One being energy, that's been on the move here in response to the recent sanctions or announcement of new sanctions on Russia and how that could impact oil supply. So I also want to take that with a grain of salt and realize that could also mean bad things for inflation. So, I think that it's just interesting. We're seeing a little bit of a give up here, but I think that's because this optimism that fueled the rally post-election has been replaced by concerns about not economic growth. Economic growth is fine. It's about inflation, and it's about new inflationary pressures and the fact that the Fed is likely going to have to respond. And by responding, it could actually be no response at all, meaning that those who are waiting for additional policy cuts are going to have to wait quite a while if these inflationary pressures persist, and that could mean a more tricky stock market to navigate. So, obviously not the start we wanted for the year, but we should also just be mindful that 2023, 2024 were very strong years for the stock market. So a little bit of a pause, I think, is warranted.
So, the strong jobs report that came out on Friday, the first Friday of the month, this time it came out on the second Friday of the month because of various situations that hit the calendar. But that came out on Friday, and the 10-year Treasury kind of started racing higher. I think it's, as of recording, we're around 4.79%, close to 4.8. Historically, that's kind of a good time to stay in cash or bonds because you're getting such a great yield compared to inflation. Let's talk about that jobs report because, Adam, that was a one that came out on Friday that it's good news. We have jobs. We'll spend our money. We'll help the economy. Companies in corporate America will take advantage of that and make earnings. Why is the good news the bad news, in your opinion?
I
Good
think
news
it
for the
just
jobs, bad news for the stocks.
Yeah, so look, we saw 256,000 jobs added in the month of December. That's a really strong number. I think again, you're seeing a little bit of noise here because of recent weather-related issues, the hurricanes at the end of the year, maybe some noise still from the strikes that lingered into this period, which was December. But it was a strong report. We saw the unemployment rate tick down to 4.1%. So I think that tells you this is a strong economy. The jobs market is still healthy. Now there is some softening underneath the surface. Things that we talked about last week was the rising duration of unemployment. So the fact that even though we're still seeing hiring, there's still some signs of softness and maybe a reluctance among employers to go out and hire too aggressively. But we're not seeing that translate into layoffs yet. That much is clear, and so that is good, right? I think that that's really important. We should celebrate that. Now, the reason that you saw the response in the stock market and really the bond market, I think, is what was responding to it, is because what does this mean for the future of monetary policy? We know the Fed and most others want interest rates to move lower, and as long as the economy remains this strong, this resilient, the Fed doesn't have the wiggle room to cut policy rates. Now, when they started cutting rates several months ago, they were focused on ensuring this soft economic landing, meaning they kept rates high for so long. They wanted to back away from that when they were seeing progress on inflation before overstaying their welcome in this high interest rate environment and really doing more harm than good to the economy. So that's why they started with these rate cuts. Now it appears that they may have actually been a little bit too eager to get that process started because in fact the economy is not showing signs of softening. It's actually I'd say really healthy, and so what that means is it's brought back these inflationary pressures. And so in response to Friday's jobs report, we actually saw pricing or expectations for future policy tightening get pushed out. And so now we're seeing that the market is actually not expecting the next interest rate cut to come until October of this year. So
Wow.
we could be at these levels for quite some time. Now things can change. We're
Yeah.
constantly getting new data. The Fed is data dependent. We know that there's a new administration coming. There'll be President-elect Trump has his inauguration coming up in a week from today, and so then we'll learn more about how policies might change. But for now, expectations are the Fed is not going to be in any hurry to cut rates further. They really need to shift their attention back from the protecting that soft economic landing to these renewed inflationary pressures. And that's why you saw the market respond the way that it did Friday following that report.
So probably in about a week, late January, we're going to start seeing appointments get approved by the Senate and Congress, the House of Representatives, and or not. And that'll bring up some questions, and then maybe it'll finally answer some answers too of what sort of policy we're going to see. So I'm hearing you on that. Now, this week, Tuesday and Wednesday, we're going to get the PPI, I believe, on Tuesday, and the CPI on Wednesday, so the
Mhm.
Producer Price Index and the Consumer Price Index. Um, I don't know what the expectations are on those. Can you give me a little bit there, and maybe could this be a catalyst to stabilize the market and maybe move the market higher?
It could, sure. It could also be that catalyst to send 10-year treasuries closer to 5%,
Okay.
to that danger zone that we kind of, if 5% is just a random number, it's a psychological number, but we look at that as saying, okay, maybe that's the ceiling that investors look at that and say, okay, that's where I start selling equities a little bit more aggressively. Um, but that all remains to be seen. I'd say that the expectations, though, for the inflation reports coming out tomorrow and on Wednesday, CPI specifically, the Consumer Price Index, is for core inflation to maintain a three handle, and for headline inflation, meaning if you include food and energy prices, to be in the high twos. And I think it's just going to be this ongoing evidence that inflation remains stubborn. It remains sticky, and that path towards that 2% level is not easy. We've made tremendous progress from when inflation was at 9%. We're closer to let's just round it to about 3%. That's still a far cry and much too far away from 2% for the Fed's liking. So for that reason, that is again just the in a nutshell why the Fed is going to remain very cautious here about cutting rates too aggressively. They really want to make sure that monetary policy is tight enough to keep a lid on these this inflationary pressure. And so if Wednesday's report and tomorrow's report for PPI come in higher than expected, if they surprise to the upside, we could see the market respond to that. And what I'll be focused on is how the bond market responds. If we see a meaningful surprise to the upside, then sure, we could see rates move a little bit higher here in the interim. And that might put short-term pressure on equities. If we do see some volatility there, I should just highlight that doesn't mean that we need to run for the hills and make meaningful changes to our portfolio. Again, I really want to take it back to 2023, 2024, where we saw back-to-back 20% plus years on the S&P 500. And these were years that didn't see a whole lot of downside volatility. I think the biggest peak to trough uh, drawdown that we saw in the S&P 500 was about 8%. So not even a 10% correction last year. So if we do see some volatility, I think it is normal. And even though we've been without it for quite some time, we need to remember that's just a normal part of investing.
So I think you're kind of telling me the Federal Reserve is going to take away the easing of interest rates. And when they ease, stocks can outperform just on that alone because it's stimulative to the economy and expectations grow from there. So now we're going to have to count on earnings, Adam. And we're moving into earnings season. We're going to go through the fourth quarter earnings starting this week. I know we get JP Morgan, Bank of America, Goldman Sachs, amongst other financial institutions. Then we start getting into the tech companies a couple days after that and into next week. What are your thoughts about earnings season? From talking with you last quarter, numerous times you were talking about how earnings expectations are starting to rise. And do you think those might be too high? Or could we be setting up for disappointment here?
That's always the risk, and I think that was so well said, Rob, because these companies, the equity market needs to go it alone right now. They don't
That's
have
right.
the support of monetary policy here in this current environment. Maybe they'll get some fiscal policy support down the road. We don't know when it comes to things like lower tax rates for corporations. That's all down the road. For now, we really need to stay focused on earnings. So as you said, fourth quarter earnings season is about to get underway here. It starts as usual with the banks and larger financial companies on Wednesday. Heading into this quarter's earnings season, we're looking at about let's call it 11% or so in terms of year-over-year earnings growth in the fourth quarter. Now, we have seen 11 straight quarters where actual results were better than projections going in. So that's good. We'll see if that streak continues here. There's always that risk that it doesn't, and that creates some downward pressure on stocks. But heading in, I'd say expectations are fairly good for the full year. That in 2025, we're looking at about 13% expected earnings growth this calendar year. And so I always when we're going through this earnings season, I obviously these results are backward looking. It's fourth quarter. That's done, right? And so what's more important for me is what are executives and management of these companies saying about the go forward environment? What do they see for 2025 for the next couple of quarters? Because uh, we have a more difficult monetary policy environment in which rates are unlikely to fall too quickly, or at least anytime soon. We have policy uncertainty related to the incoming administration. We have a rising dollar. There's a number of factors that are at play here, and so I think it's going to be really interesting to hear from management about what this means for their specific business, for their industry, and because of that, we're going to be watching how forward projections for earnings growth change here in the coming weeks. If we see meaningful move lower in terms of future earnings growth, that would create a little bit of anxiety here for us because we know, again, as I said in the beginning, that stocks need to go it alone here. We need to focus on fundamentals and what really drives stock prices over the long term, and that's earnings growth.
Thanks very much, Adam. I want to encourage anyone who's watching this video to reach out to their financial team, give them updates, start the new year off with more information, and get any questions answered that you might have. I'm Rob Black for EP Wealth Advisors Informed Investor Market Update. He is Managing Director of Investments, Adam Phillips. Thanks very much, and I'll talk to you soon, Adam.